or scene script. Ever wondered how to balance risk and return in your investments? Let's delve into the world of finance, where we often face a curious dance between risk and returns. Think of it like a seesaw. On one side, we have risk, the chance that your investment may not perform as expected, or worse, you might lose it all. On the other side, we have returns, the money that you stand to gain from your investment. Imagine you're at a carnival, ready to take a wild ride. Stocks are like the roller coaster, thrilling, potentially rewarding, but accompanied by stomach-churning drops. When you buy a stock, you're buying a piece of a company. You're an owner now, and as an owner, you stand to benefit from the company's success in the form of increased stock prices and dividends. But beware, stocks come with their fair share of risks. If the company doesn't do well, the stock price can drop, and you might lose your investment. But what if roller coasters aren't your thing? Perhaps you prefer something steady, like a Ferris wheel. That's where bonds come in. When you invest in bonds, you're lending your money to an organization, and in return, you receive interest payments. Bonds are generally less risky than stocks. But remember, they're not entirely free of risk. The value of bonds can be affected by changes in interest rates and the creditworthiness of the issuer. Now, what if you want a bit of both? The thrill of the roller coaster and the steadiness of the Ferris wheel. Enter the world of mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, and other securities. This diversification helps to spread the risk and can potentially increase returns. Plus, they're managed by professionals who make informed decisions on your behalf. So, as we can see, it's all about balancing the potential for higher returns against the risk of losing your investment. Whether you choose stocks, bonds, or mutual funds, each investment type has its own risk and return characteristics, and the choice often depends on your individual financial goals and risk tolerance. To illustrate, let's follow the journey of an investor named Priya. Priya was a young professional who had recently started her investing journey. Eager to grow her wealth, she plunged into the world of stocks, attracted by the stories of high returns. She bought shares of multiple companies, hoping for a quick capital appreciation. However, the stock market's volatility soon hit hard, and Priya found her investment values swinging wildly. In some instances, she even faced significant losses as some companies underperformed. Disheartened, Priya decided to switch gears. She moved away from stocks, turning her attention to bonds. The promise of regular interest payments and the return of her principal at maturity seemed like a safer bet. The stability was comforting, but soon Priya realized that the returns from bonds were not quite as exciting as she had hoped. The lower risk came with lower returns, and Priya felt her financial goals were still out of reach. Then, Priya discovered the world of mutual funds. She liked the idea of diversification, of not putting all her eggs in one basket. The fact that her money would be spread across various assets, managed by professionals, appealed to her. She was also pleased to learn that mutual funds were relatively liquid, allowing her to buy and sell whenever she needed. With mutual funds, Priya found the balance she was seeking. She could enjoy the potential for high returns from equities, the stability from bonds, and the diversification benefits of having her investments spread across different asset classes. The management fees were a small price to pay for the convenience and potential returns. Priya's journey is a common one. She started with a focus on high returns, faced the harsh reality of risk, and then discovered the importance of balancing risk and return. She realized that diversification was not just about spreading risk, but also about optimizing potential returns. Priya's story shows us the importance of diversification and finding the right balance between risk and return. Now, let's summarize the key points about risk, return, and diversification. We've explored the unique characteristics of stocks, bonds, and mutual funds and how these three investment vehicles interact with risk and return. Here's a quick recap. Stocks are pieces of ownership in a company. They offer potentially high returns in the form of capital appreciation and dividends, but they also carry a high level of risk due to their volatility. Investing in stocks requires a strong stomach for risk and a long-term perspective. Bonds, on the other hand, are essentially loans to a corporation or government. They deliver regular income through interest payments and return of principal at maturity. They are generally seen as more conservative investments, offering less risk compared to stocks. However, they're not entirely risk-free. Interest rate changes and the credit worthiness of the issuer can affect bond values. Mutual funds offer a middle ground between the risk-reward spectrums of stocks and bonds. They pool money from multiple investors to invest in a diversified portfolio of securities. This diversification helps spread risk and potentially optimize returns. Mutual funds are professionally managed, providing access to a range of assets without the need for individuals to buy each security directly. Remember, understanding your own risk tolerance and financial goals is crucial before embarking on any investment journey. Each of these investment types serves different financial goals and risk tolerances, so the choice often depends on your unique needs and circumstances. Diversification, particularly through vehicles like mutual funds, can be a sensible strategy. It allows you to spread your risk across various asset classes, potentially smoothing out the peaks and valleys of market volatility. This can help you balance risk and return in a way that aligns with your personal risk appetite and investment objectives. Remember, the goal is not to eliminate risk, but to manage it effectively to achieve your financial objectives. No investment is without risk, but with careful planning and consideration, you can navigate these risks to help secure your financial future. So, are you ready to start your investment journey? Remember, taking the first step towards investing might feel daunting. The financial world can seem like an intricate labyrinth of numbers and jargon. But the reality is, with a solid grasp of the basics, it doesn't have to be intimidating. Understanding the core concepts of risk, return, and diversification can make the process much more approachable. Think of it like learning a new language. At first, it's all unfamiliar, but once you master the alphabet, the words start to make sense. In the world of finance, risk, return, and diversification are your alphabet. Investing isn't just about making money. It's about securing your future, achieving your financial goals, and gaining the freedom to live life on your terms. So start today. Do your research, understand the risks, diversify your investments, and watch your money grow. With the right knowledge and strategy, you too can find the perfect balance in your investments. Happy investing!